Tarek, I would love just to start with a question of what predictions markets are, why do they matter in your own words, and why did you start on this journey of Kalshi to allow people to trade on the outcome events?
Yeah, it's a great question. I went to MIT, and then at MIT early on, I was really interested in finance and worked at Goldman, Citadel, worked at a number of prop shops. And what was really interesting to me is how a lot of the activity for institutions or high net worth individuals or the bank itself or the hedge fund was, okay, we come up with a certain belief about an event. And in 2016, right before the Brexit referendum, you have all these institutions coming in and they're asking, we want to hedge ourselves against Brexit, or we want to get exposure to Brexit. We want to make a better trade on Brexit. And then we would come up with these sort of super complex financial bundles, think swaps and options and a bunch of things that would bundle together.
Yeah, and it's a super important business risk you might want to hedge against. But as you can imagine, trying to price that in with existing options and swaps, it's a Frankenstein monster you end up with.
It felt like a Frankenstein. You're trying to put different curves and try to fit them into this binary outcome. And then we would charge really high prices for this. Some of these products would go for like 40% spread. And people would buy it because it was called exotics. It's this esoteric thing, but there was a lot of flow there. And this is where the question of like, okay, why do we not have an exchange, like not New York Stock Exchange, NYSE, or CME, where the underlying is events? Events are real, they have economic value, and they're tangible to anyone, more so than traditional stocks or oil futures. Yep. So this is where we start obsessing about the idea.
Nice. And then in terms of starting to obsess about the idea, there's always the question of actually getting started. This is not necessarily easy to get off the ground. So why did you end up taking the approach of deciding to be regulated? What did that look like? How long did it take?
Was this sort of idea that was just like constantly in my brain. Like it just made so much sense. It just makes so much sense, right? And why is it not there? You look at the history of these markets and it's like consistently, it's that anytime any attempt at this kind of gets to any critical mass, it would get shut down. The CFTC just sort of was not comfortable with these markets. It was not done in a regulated way. And so I think we were, I would say, very ambitious, bold at the time, but also naive. And we can talk about naive a bit. I think we were like, okay, it's a big challenge, but also an opportunity. So we should do this. It took 2 years and a half. I felt like 2 years and a half in a desert. And a desert without really knowing if there's an end to this desert. So it was definitely very tough until we got to it in November 2020 is when we got regulated.
Yeah, naivety is something that's pretty important for a lot of entrepreneurial activity, because if you know how hard it is before you set out, you might never be willing to make the jump. One thing to be interested on the regulatory front is, you're not the first person who's built some form of prediction or outcome market. There are some other folks, and actually some of them actually do operate in limited way within the US. So maybe talk about some of those examples, just give people a feel, and then also some of the limitations that exist.
Yeah, definitely. So I think there is one type that's just fully unregulated. Some of it is decentralized, some of it is offshore. Typically, when they get to a certain critical mass, tries to sort of shut them down. I think the second category is a category of, I think there's one or two operators that are like predicted. And I think there's another market called IM that's pretty much defunct now, but they operate under what we call a no action letter. So think of it as a safe haven that the CFTC has granted for 3 reasons. Like one, they're nonprofit. 2, they have low limits of exposure. So in some ways, keep it low scale. And 3, they're for research purposes. And limited to a certain subset. It's not everything. The difference here, the regulatory difference, really we're going for full-blown exchange that wants to build liquidity or volume that, equals places like CME more recently.
Yeah. Basically, some of the ones that exist in the US, very subscale with very strict limits about like dollar amounts that you can invest, et cetera. I'd love to hear a little bit about like the type of product you settled on, like the specific kind of contract, why that's interesting, and also give people an example of some of the kinds of things that you can trade on the platform.
I would say decently topic agnostic. Right now, we have things. So if you look at the homepage, we have things around COVID, transportation, economic, politics, climate, and weather, world events like, will Turkey join the EU?
Yeah, all binary events, basically, yes, no.
Correct, yeah. So for now, we are mostly focused on binary events. So whether an event is going to happen or not. So will the infrastructure bill pass or not? Will COVID numbers be above a certain level or not? That said, I would say there's a few dimensions across which we want to expand in the future. One, the universe of contracts that we're offering, and we're increasing contracts, adding contracts on a weekly basis. And then 2, I would say also do linear or non-binary things. You can imagine, let's say, an index that's tracking COVID or an index that's tracking climate change and all sorts of different things that we would do.
Yep. What were some, I'm curious, like the highest volume contracts in the last week or month since you went live in July?
Well, one of the really interesting contracts was the infrastructure bill. A lot of people are following this. There's pretty clear economic value. There's a lot of interest. It's all over the news. And then I think it had some interesting swings, right? Like, on Friday, people thought, okay, it was going to pass this week. And I forgot who exactly kind of came out and said, we're going to delay it to some extent. So there were like interesting price swings in that market.
Yeah. And you can see basically some of the things I noticed were, politics, infrastructure bill, pandemics, will COVID cases go up, down? Climate, will this be like the hottest year on record? Yes, no. Which it gives you a sense of like the breadth of the kinds of issues you can cover that are of societal interest. I'm also curious, when you launch a company, no matter what that company is in fintech, one of the question is, who is the customer? What are they using it for? And I think there's a lot of societal benefit that comes from markets, price, and information, just as a viewer, being able to see what's going on, what people think will happen. Because right now there are a lot of experts who basically have no skin in the game. And so it's very hard to understand whether or not they're good at predicting things. But that's almost like a beneficial side effect of the markets. So I'm curious who you think like the users are, and like who ends up using it for economic purposes, and why, and who those users are today versus who they might be in the future.
This is a great question. I mean, I'll talk maybe a bit about the long-term vision in the future, and then maybe we can reverse engineer how we're thinking about it today.
Yeah.
So I would say it's a very diverse user base, both institutional and individual, that are coming for different reasons. The path that we're taking as an exchange is we're starting with retail, and retail by that I mean individual. I mean, really we think of it as like smaller scale individuals with lower traded amounts, but they trade more frequently. And then with time we want to go through that scale to bigger and bigger entities, whether people or individuals that are trading maybe lower velocity but higher volumes, right? It's one big institution that wants to hedge or take an exposure to what's going to happen with the Olympics or COVID, but they're taking more of a $10 million, $20 million trade rather than right now what we're seeing maybe $5,000 to $10,000 trades, or even 100 or 50 or $10 trades that people or individuals are. We're thinking of building liquidity incrementally. Think of building blocks that are bigger and bigger as we sort of bootstrap ourselves to liquidity.
Yeah, it would start in any market. You've got to bring on multiple sides, which is an interesting question, and you guys have obviously chosen to start with retail. Another question is, what all did you have to build to bring this into fruition? You talked about taking 2.5 years just to get the regulatory license, and that was new and that was hard and different. But you had to build, like, there is no New York Stock Exchange for outcome contracts. There is no like clearing house. There is no brokerage network. So talk to me about like what you had to build, how much you were able to build in-house versus borrow from other places. So I think the infrastructure aspect of bringing a new market online is as interesting as some of the aspects around like what problems that market itself solves.
Yeah, I mean, when we started, we thought we were going to need to build this. And as we started building, we started realizing like, oh shit, we need to build 10x more. And then, after a bit, it's like, oh, wait, actually, it's even 10x of that. And then, it went on for like maybe a year and a half. Then we got the full scope. The way I divide it is exchange infrastructure. Think build a New York Stock Exchange from scratch. So it's like what we call the matching engine of trade execution. It's like the thing that's matching the different orders. And It has to be fast. It has to be performant. It cannot make mistakes. And I really emphasize it cannot make mistakes. But that's really hard to achieve because a mistake could be disastrous. I think reporting infrastructure, which is a whole thing in and of itself, report data on a real-time basis to very kind of old school systems that, whether it's a regulator or other sort of data repositories, and that is kind of a very complex problem in and of itself. A clearinghouse integration, I would say that was by far the most difficult piece because none of the clearinghouse setups today are set up for this. And it took a lot of, I would say, begging and convincing to secure a clearinghouse that is willing to do this, that can even do this. And there's just a lot of small details on who, is this our customer, whose customer, how the funds flow. There's all these details. I mean, it took us 9 months to negotiate a deal and then another 9 months to actually set up the integration. So it was very, very tedious process. I would say trade surveillance systems are another big part of it, which is, think of it as like when you hear on the news, I don't know, some banks trader got charged by the SEC for insider trading. There's systems that monitoring trade activity and flagging, for weird patterns. And we decided to build, except for our own clearinghouse, we built everything in-house. Big decision, a lot of convincing the CFC because that made them also uncomfortable. But the reason we did this is every dependence on the players in the derivatives industry is really painful, really slow. You're talking about a 6 to 1 year cycle instead of a 1 to 2 week cycle. And I really mean that because they have so many other priorities. And so in retrospect, I still think it was the right choice to build a lot of the full stack sort of house essentially.
Right now, a lot of fintechs have the choice of, do I want to build this in-house versus do I get to rely on some of the infrastructure that's come online recently? But yeah, in your case, there really wasn't much of a choice for a lot of it. You just you had to build it. We're kind of coming to the end of the discussion. I'd love to touch back on what's kind of the vision for Kalshi 10 years down the line and for this industry generally.
Yeah, definitely. I see event contracts as really the next natural evolution of financial instruments. It is something that's really tangible, really clear. I always describe it as the most human or natural asset class of all the ones that preceded it, because all you need to trade is really an opinion. The hope for Kalshi is building the ecosystem for that. So whether people are trading via us, via their brokers, via, I don't know, the API, if they're hedge funds or institutions. And so that's really the long-term vision, becoming the New York Stock Exchange or events.
Yeah, and it'll be fascinating to see all the various ways in which people integrate. In the future, you're not just going to have a consumer front end where people can log in and trade. You are more like the stock exchange, so you'll be integrated with other brokers and offer all sorts of other ways for people to engage in the core idea of trading on the outcome of events. So I want to say again, thanks for coming out, chatting with us and the rest of the Cambrian community.